Those stocks beat the market by an eye-popping amount, by typically over 10 percentage points.
Tweedy Browne Investment Committee member John Spears explains how the legendary value firm is investing in buying by corporate insiders. He is on Consuelo Mack WealthTrack.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. It is not often that a 105-year-old investment firm makes news, but that is exactly what happened late last year. The firm is Tweedy Browne, an old-line investment manager with an impeccable pedigree as a value investor. Founded in 1920, it had offices in the same Wall Street building as Benjamin Graham's company and became his broker. As WealthTrack viewers know, Graham is considered to be the father of value investing. He published what is now considered to be the Bible of value investing, The Intelligent Investor, in 1949. In subsequent editions, Warren Buffett calls it by far the best book on investing ever written. Tweedy Browne also became Warren Buffett's broker and helped him quietly acquire shares of Berkshire Hathaway in the 1960s. The late Charlie Munger, Warren Buffett's legendary business partner, described Tweedy Browne members as absolute descendants of Benjamin Graham. They are like Buddhists or Tibetan monks who absolutely bought into the catechism. That might be the case, but the firm is very much in the 21st century. It recently launched its first new product in 15 years, which is also its first ETF. The Tweedy Browne Insider and Value ETF, symbol COPY, focuses on undervalued companies whose managements are buying company stock and or are engaging in active stock buyback programs. Why an ETF? Why the emphasis on insider buying and share buybacks? Joining us is John Spears, who joined Tweedy Browne in 1974. He is a managing director and member of the investment and management committees. Spears and the other 6 investment committee members oversee the firm's funds, including the new ETF. Spears has co-managed its $4.5 billion flagship fund, Tweedy Browne International Value, since its 1993 launch. The fund carries a bronze analyst rating from Morningstar and was named Morningstar's International Fund Manager of the Year in both 2000 and 2011. I asked Spears why the firm decided to launch an ETF with a focus on corporate insiders buying.
Well, the big thing I think that tipped the scales was the empirical research that had been done before by Professor Sayan at the University of Michigan. He wrote this book called The Investment Intelligence from Insider Trading, and he did a 16-year study that ended in 1993 and found that when you copy the insiders and you also have a low price earnings ratio and a low price or a low price to book value, you're in the cheapest 20% if you rank the stocks on price to book or PE, that those stocks beat the market by an eye-popping amount, by typically over 10 percentage points. So that really got our attention, and we did our own study that began in 1996, ended in 2022. We used a lot more different kinds of characteristics than what Professor Sayan had used, and we found the same thing in not only the United States, but in the UK, European companies that trade in the euro, and then Canada, Australia, Singapore, South Korea, other countries around the world. It just seemed to be repeated over and over and over again. So that said to us, maybe we should try to roll this out as an investable product, not only for ourselves. We're fortunate to have over 30 million of our own money invested in copy, but for our clients, and it would be wrapped in a very tax-efficient way. ETFs have ways of typically avoiding realizing long-term capital gains, short-term capital gains. So that can be a big boost long run to returns for tax-paying investors. So that's how we got going. We just thought, It's a way to make money for ourselves, a way to make money for our clients.
Why did it take so long, and why now?
I think we've always had an interest in empirical work, but it was really the evolution of technology and the availability of a data set that would allow us to see how insiders, in combination with value characteristics, how those things had performed over 6 months, 1, 2, 3 years forward. So that's how we got going.
And what kind of excess return can one expect when you see management, buying their own company's stock?
What kind of excess return? We hope it'll be good, but the experiment is still continuing. We will wait and see. We've seen great excess returns in historical studies. Those studies inform our strategy. I can't really give you an honest answer. If I knew that, I'd be Warren Buffett,
Right. How do you differentiate when you're seeing buying by corporate management? How do you differentiate what's just their regular estate planning or whatever, or they're looking at the price of their company's stock and they're saying it's cheap?
One of the things we do when we get a high scoring stock, those are indications of undervaluation, is we will look in the annual report, the 10K, et cetera, to see if there are requirements to own a certain amount of stock in relationship to the income of the executive. It's often 3 or 5 times the amount of the executive's salary or annual compensation. So we'll check that out, and if it doesn't meet the requirement, we'll call it a non-free will stock. They have to buy it. We don't treat those seriously. It really has to be a free will purchase. They've already met their compensation, their employment agreement requirements for ownership of stock, and they're buying more, so that's free will, it's voluntary. They don't have to do that. They're doing it presumably for the main reason that people buy stock, they think it's going to go up.
You told me something really interesting before we started recording, and that was the fact that you get a ton of information about companies where there is buying by insiders. I mean, every day. And we're talking about an international set of companies as well, so it's both domestic and international. How does a company make the cut?
United Health is in the news, United Health Company, and that's one that entered copy several weeks ago.
Good timing.
The insider profile, the signal just punched you in the face. The former CEO, chairman, he's coming back as CEO. He already owns stock. His name's Helmsley. He bought $25 million worth of stock at a price of about $290 a share. The stock had traded as high as $600 a share just a few months before in April. And the CFO bought $5 million worth of stock, and 3 other insiders bought another $1,500,000. So that just went pow. That's a strong signal. A lot of money, cluster of buying, not just one individual, but it also was a high-scoring stock, and it had
high scoring as far as your valuation.
Yes, that's right. I mean, it was selling at 11 times earnings. You convert that into an earnings yield, that's a 9% yield. It had very good growth in the past. I think the 5-year compounded growth rate in the dividend was about 14%. Earnings growth had been 16% for a number of years. It had been a pretty steady earner. It's a major company in health insurance and in related fields, and very high return on capital employed. And that's one characteristic that Warren Buffett likes. And today the news is that Berkshire Hathaway has bought a position in United Health. Another famous investor, a well-known investor by the name of, I think his name, David Tepper at Appaloosa. Mm-hmm. His firm also has been a buyer. And also, just 3 months before the insiders bought, the company was buying back its own stock. They bought 1.5% of the outstanding shares. That's 6% annualized. that's pretty good. That's a fairly high buyback ratio.
And that's another criteria that you're looking at, is not only the buying by corporate insiders, but also you're looking at stock buyback programs. And how important are those programs as well as an indicator?
We're doing more empirical research on share buybacks right now, but so far it looks like if there's a share buyback and there's not a contrary signal from insiders selling, the companies, Stocks 10, they have a buyback program for 7% of their outstanding shares, but you see nearly all of the insiders are selling their own shares into the share buyback. Well, that's a mixed signal. I don't think you want to see that. On to the next one. But if the company is buying back its stock, it's announced a buyback program, it's a fairly significant percentage of the company's shares outstanding, and it has good value scores. That seems to be correlated with excess returns, at least over the next 12 months in the cheapest decile.
How long does the effect last? You just mentioned for the next 12 months with stock buybacks. What about buying by corporate insiders? How long does that effect last?
The research that we've done indicates that it tends to go for about 2 years, pretty good returns for 2 years, and then seems to flatten out in the third year.
John, as far as the number of companies that you have in the portfolio, you have in the ETF copy, it's about a couple hundred, right?
If you're trying to mimic characteristics in a study where every stock has an equal weighting, and you might have in one decile on price earnings ratio 200 companies, we think we'll have a better chance of mimicking the empirical strategy that kind of results by having a lot of bets.
The portfolio turnover, do you have any idea what it's going to be? I mean, you're basically 6 months in, so.
Well, based on the empirical data, we like the idea of constantly refreshing the inventory, constantly getting the new ideas coming in, and we're valuing all the new candidates every day that by computer. The computer will do 30 calculations of more than 30 different ratios for every stock that comes in every day and does the scores. And the tendency would be to try to phase out of the ones that we've held for 2 years unless they've been reinstated. That often happens. If the stock's still cheap, insiders may continue to buy it, in which case we'll reset the clock. It would go in if we didn't own it now. So we give it a new 2-year clock in a way. And then the other thing is the scores. If the scores are going down, it's usually the two reasons. The fundamentals are deteriorating, or the stock's gone way up, and then the score goes down.
Talk to us about the score. What goes into the score?
I can't give you those. Yeah, it's proprietary.
Okay.
It's our secret sauce, but it certainly does include dividend yield, share buyback yield.
And I think you mentioned
price earnings ratio, price to book, price
right.
to tangible book, and many others, many others. Things that measure stability. It's a value factor in terms of common sense, but if we rank stocks on stability, we didn't see excess returns just on that alone. No, I mean,
right.
You can have a steady earning pharmaceutical company, but if it's at 40 times earnings, it's not necessarily going to beat the market, but it might.
We've got buying by corporate insiders. We have stock buybacks. Is there another key indicator is that significant as far as an indicator of excess return?
We haven't been able to come up with any in empirical studies. I think the what has worked in investing, common sense on knowing something about business acquisitions and how companies are valued. One of our partners, Tom Schrager, is a former investment banker. We have that kind of a mentality. We've been involved with deals ourselves. We were in the leverage buyout business with Browne for a number of years and got out of it, but we haven't been able to find anything else. Now, there's one thing that hasn't been researched that much that did come up in the empirical studies. One of the interesting deciles was the worst decile on valuation. There was a pretty high decile on future returns, i.e. momentum. Things are going well. The stock's gone up in the past, and then it continues going up. There was a little bit of a sign of that fairly well-studied characteristic. For die in the will value people, that's a scary thought. You might be able to see it with, let's say a pharmaceutical company. They've had some good news, but then maybe there's a dip. There's some announcement that analysts don't like, and the insiders are buying it. Not necessarily cheap on earnings, but you can do a lot with a pharmaceutical company. Pricing power is enormous. I mean, people have bought insurance companies and quadrupled the price of different pills, and so they can make, or you can get rid of the sales force and take the company in. You'll pay a higher multiple because you're getting more earnings. So all these things can enter into a more nuanced, more sophisticated evaluation.
It sounds tantalizing. Clearly, you all are paying attention to it.
Well, as my deceased good partner, Chris Browne, used to say, it's juicy.
I love it.
It's juicy.
Right. You mentioned that there are a lot of stocks that don't make the cut. Can you give us an example of a company where there's been a lot of insider buying that came across your desk? And
we were talking a little bit about this company, which I reviewed yesterday. The company met the value score, had a good score, had a cluster of buying. I think 4 or 5 insiders were buying it, and they were each buying almost 1,000 shares, 1,500 shares, and they met the criteria for ownership. But we noticed the CEO hadn't bought much stock at all over the years. The CEO was paid $9,200,000 a year. He bought 175,000. So that
pocket change.
Pocket change, exactly. The company, after the close of its second quarter, which ended June 29th, on June 30th, closed on an acquisition for $840 million. And that was a pretty significant increase in the company's net debt, its overall debt. And the only information revealed by the acquirer, the company we're considering investing in, is that the earnings accretion in the first 12 months of ownership would be 10 cents a share. That worked out to about $4.4 million. There were 44 million shares outstanding. And they paid $840 million, and that was about $19 per share of this company. And that worked out to an enterprise value to net income multiple of 190 times. So less than a 1% yield, after-tax yield, on the total purchase price of the acquisition. They could have done much, much better if they'd taken the $840 million and just bought their own stock at the prices that it was trading at. And there were some other things. It was annoying they wouldn't report segment data for all the different things they were in. They only reported geographic data, and some of the revenues from the segments were declining. Too hard. On to the next one.
As Warren Buffett would say, right, and Charlie Munger.
Exactly.
The too hard pile.
Yeah, the too hard pile. Right, we love that. Or just not a fat pitch.
I had mentioned earlier in the interview that the price-to-book ratio for the S&P 500 is at a record high, higher than it was at the peak of the tech bubble. That's one indicator of how expensive the S&P 500 is. From a value investor's perspective, how expensive is the U.S. market?
We recently had the good fortune to have received a newsletter from an investor that we have a great deal of respect for, Howard Marks, of Oaktree.
Oaktree.
Yep, and one of his recent newsletters had a chart that just punched us in the face. It was a chart prepared by J.P. Morgan Asset Management that went back 27 years, and every month they bought the S&P 500, and then they held it for 10 years forward, and they calculated the price-earnings ratio at the time of the purchase. Well, what they found is that over 27 years, when the PE of the S&P 500 was about 21 times or higher, now it's 28 times, but when it's 21 or higher, that the forward returns are nothing or loss.
Wow.
And that just punched me in the face. This is a really high-priced market. A 28 multiple of earnings equates to about a 3.6% earnings yield. The dividend yield is about 1.2% on the S&P 500. So I'd go elsewhere, Go to copy, or go to Tweedy, Browne International. Anyway.
As a value investor, is international the place to be?
You can look at the statistics of the MSCI Europe Value Index. They kind of punch you in the face versus the S&P 500. The dividend yield on the MSCI Europe Index is 4.4%. The PE ratio, looking out a little bit, is 11 times. That's a 9% earnings yield. Price to book is about 1.4. Those are really interesting low average numbers. Same thing with the MSCI EFA index. That has similar low. Dividend yield over 4%, PE of around 11, 9% earnings yield. Price to book about 1.2. Cheap, yeah.
Considering that the U.S. has outperformed international markets for well over a decade, and how do you keep your morale up at Tweedy Browne, a value shop? And you've lost assets because of the fact that value and international value have lagged. They haven't lost money, but they have lagged considerably. How do you keep doing what you've been doing?
Well, I swim laps. Try to relax. No, you count your blessings. I think that you really have to have a belief based on common sense that long run, and this has been true for my 50-some year experience, that it makes sense to buy things that give you more for your money. If you got something with an earnings yield of 10%, it's just obvious that that's a higher yield than something that's at 100 times earnings gives you an earnings yield of 1%. I mean, it's just
common sense.
Common sense. You just can't fight it.
One investment for a long-term diversified portfolio. Is there one thing that we should all own some of in a long-term diversified portfolio?
Well, I can't mention our own firms.
No, you cannot.
No, I cannot. Well, I think based on the research that we've done recently on index average results, that I think that MSCI may have a European value ETF that would be an interesting addition given the times we're in right now, certainly compared to the empirical results of the S&P 500. So I think having some of that would be a good idea, and if it's wrapped in the ETF package, as they rebalance, they'll be able to get rid of stocks with gains without you having to incur long-term capital gains tax. It's not a nutty idea. I think it could do quite well.
Thank you, John Spears, so much for spending time with us on WealthTrack.
Well, thank you, Consuelo. It's good to be interviewed by you once again. You're very thorough. It's stimulating to do this.
At the close of every WealthTrack, we are trying something new. Instead of giving you our one suggestion to help you build and protect your wealth over the long term, we are asking our guests to share the best investment advice they have ever received. This week, John Spears obliged us with wisdom from Benjamin Graham, considered to be the father of value investing. This week's action point: buy at a discount.
The best investment advice I ever got was from Benjamin Graham's book, The Intelligent Investor, which teaches the reader that there are two prices for every stock. There's the intrinsic value, which we think of as the value of the business. If you and I owned it, we were to sell it, and if that's $100 a share and you can buy it, let's say at 50, you're getting 2-to-1, in a way, collateral coverage backing up your investment. And you've got the prospect for a nice gain if the stock goes from 50 to its intrinsic value. Maybe there's a takeover, et cetera. And you've got leverage while you're owning the stock. If the stock's value goes up by 10 or 10% on 100, that equates to a 20% return on your cost of entry. So that is arithmetic that has always just seemed elegant, beautiful to me and others at our firm.
Two prices for every stock, one the market offers you and the other what it is really worth. The key, of course, is recognizing the difference. Next week, a big overlooked risk in estate planning. Financial planning thought leader Jamie Hopkins discusses digital asset protection and other major retirement concerns. Please follow us on Facebook, X, and our YouTube channel. Thank you for spending time with us. Have a super weekend and make the week ahead a healthy, profitable, and productive one.